Every second, somewhere on Earth, someone places a sports bet. Not for entertainment, but with real money on the line. In the time it takes you to watch the first 30 seconds of this video, more than $5 million will be wagered on sports. Football matches in Europe, basketball games in America, cricket across Asia, all feeding a global machine worth more than $500 billion every year. But here's the part almost nobody understands. Most bettors believe they are playing a game of knowledge. The companies running the platforms know it's a game of mathematics. And mathematics rarely loses. So if most gamblers eventually lose, why are millions of people still betting every single day? At first glance, sports betting looks simple. Fans watch games, they place bets. Someone wins, someone loses. But behind that simple exchange exists a massive financial ecosystem. Global analysts estimate the total sports betting market moves between $500 billion and $1 trillion every year. That means betting rivals industries like global cinema, professional sports, and the entire music business combined. But the real profits rarely go to gamblers. Instead, they flow to an invisible network of sportsbooks, data companies, betting exchanges, investors, all sitting between every wager. Because in the betting economy, the smartest players are rarely the ones on the field. They're the ones designing the system. But the system itself started with something surprisingly simple. A man with a notebook taking bets at a horse race. Long before mobile apps and online sportsbooks, sports betting was run by bookmakers. At racetracks and sporting events, these operators accepted wagers by hand. But the most successful bookmakers discovered something powerful. They didn't gamble themselves. They balanced the bets. If enough money came in on both sides of an event, the bookmaker could guarantee profit. How? By adjusting the odds and charging a small margin called the VIG, usually between 5 and 10%. It sounds tiny, but when thousands of bets flow through the system every day, that margin becomes extremely powerful. Suddenly, betting wasn't just gambling anymore. It was a financial brokerage model. And once technology entered the picture, that small margin would be multiplied by millions of bets every hour. For decades, sports betting had one major limitation: geography. You had to physically visit a bookmaker, call a hotline, or walk into a casino. Then the internet arrived. Suddenly, betting became frictionless. No travel, no paperwork, just an account, a balance, and a single click. Transaction volume exploded, and companies realized something important. Sports betting wasn't just gambling. It behaved like a high-frequency digital marketplace, and the more often people bet, the more predictable revenue became. But the real advantage of sportsbooks wasn't technology. It was the mathematical system controlling the odds. Contrary to popular belief, sportsbooks are not guessing outcomes. They are managing probabilities. Odds makers analyze enormous amounts of data: team statistics, injuries, historical performance, betting behavior. Then they design odds that attract bets on both sides. If balanced perfectly, the sportsbook profits regardless of who wins the game. Imagine a game that attracts $10 million in wagers. With a 7% margin, the platform can generate $700,000 profit from a single event. Multiply that across thousands of games each week, and sports betting begins to resemble something else entirely: a global financial infrastructure. But mathematics alone doesn't explain why people keep betting. For that, we have to look at human psychology. Modern sportsbooks don't just study sports. They study human behavior. One principle drives the entire industry: variable reward. The same psychological system used by slot machines. Sometimes you win, sometimes you lose, and sometimes you almost win. That near miss creates a powerful dopamine response, which encourages another bet, then another, then another. Live betting amplifies this effect. During a single football match, users can place dozens of wagers, which turns sports betting into something very different from occasional gambling. It becomes continuous financial activity. And once investors discovered how powerful that behavior was, they rushed into the industry. Once betting moved online, investors saw an enormous opportunity. Companies like DraftKings and FanDuel turned sports betting into publicly traded technology platforms. Their strategy was simple: spend billions on marketing, acquire millions of users, monetize them over time. In the United States alone, sports betting revenue surpassed $11 billion annually just a few years after legalization expanded. Some companies spend hundreds of dollars to acquire a single user. Why? Because long-term bettors often generate thousands in lifetime revenue. But this model depends on a quiet reality. Most customers eventually lose money. But not everyone loses. A small group of bettors has learned how to fight the system. While the vast majority of bettors lose money over time, a small minority approach sports betting very differently. They treat it less like gambling and more like financial trading. These individuals are known as professional bettors, or sharps. Instead of relying on intuition or fandom, they rely on mathematics. Sharps track line movements, analyze statistical models, and compare odds across multiple sportsbooks. Their goal is simple: find inefficiencies in the market. If one sportsbook offers slightly better odds than another, sharps exploit the difference. Sometimes they place bets across several platforms simultaneously. In finance, this strategy is called arbitrage. Over thousands of wagers, even tiny advantages can produce consistent profit. Some professional bettors have reportedly earned millions. But sportsbooks are not passive participants. When a bettor wins too consistently, their account may suddenly face limits. Bet sizes reduced, promotions removed. In extreme cases, accounts are banned entirely, which creates a strange contradiction. The industry encourages people to bet, but only as long as they are losing enough for the math to work. And while professional bettors fight the system, the real battle is happening on a much larger scale. Because sports betting is no longer confined to a few countries. It has become a truly global industry. Over the past 2 decades, sports betting has expanded across nearly every region of the world. In the United Kingdom, betting has long been deeply integrated into sports culture. In the United States, the industry transformed almost overnight after the Professional and Amateur Sports Protection Act was overturned in 2018. Within a few years, dozens of states legalize sportsbooks. Meanwhile, Asia hosts some of the largest betting markets on Earth, many of them operating partially underground. Emerging markets across Africa and Latin America are also seeing explosive growth. The reason is simple: smartphones, mobile payment systems, and constant access to sports. Today, a fan watching a football match can place a bet in seconds, which means billions of dollars now move through betting platforms every single day. But the faster betting becomes, the more frequently people wager. And that shift would completely change the behavior of gamblers. For most of history, sports betting was slow. You placed a bet before a match, then waited for the final result. But mobile technology completely changed that rhythm. Today's betting platforms offer live betting. Instead of wagering once per game, users can place bets every few seconds. Who will score next? What the next play will be? Even whether the next shot goes in. Each moment becomes a betting opportunity. The result is a massive increase in betting frequency. And frequency is the single most powerful driver of sportsbook revenue. Because every wager carries the same small margin, which means more bets equals more profit. But while betting apps were becoming more addictive, another problem was quietly emerging behind the scenes. For many people, sports betting remains a casual form of entertainment. But for others, it becomes something far more dangerous. Problem gambling affects millions of people around the world. Research in several countries suggests that a significant portion of sportsbook revenue comes from high-frequency bettors. These are individuals who place wagers repeatedly, often chasing losses. After a losing bet, they place another one to recover the money. Then another. Then another. This cycle can quickly spiral into financial damage, debt, stress, broken relationships. For regulators, the dilemma is complicated. Sports betting generates billions in taxes for governments, but those profits may depend heavily on the most vulnerable players. And where enormous amounts of money move quickly, another risk inevitably appears: corruption.
I can't believe I lost it all. What am I going to do now?
When billions of dollars are wagered on sports, the temptation to manipulate outcomes becomes enormous. Over the years, multiple sports have faced match-fixing scandals. Players bribed to underperform, referees accused of influencing decisions, and organized criminal groups placing massive bets on predetermined outcomes. In some cases, entire matches have been compromised. Sports leagues now monitor betting patterns carefully. Unusual betting activity can trigger investigations. But the global nature of betting markets makes enforcement extremely difficult, because a suspicious wager in one country may originate from another continent entirely. And yet, the biggest transformation in sports betting might not involve corruption at all. It may come from technology. Modern sports betting is powered by something most fans never see: data. Every movement in a professional game can now be tracked. Player speed, ball trajectory, possession time, defensive positioning. Specialized companies collect and sell this information to sportsbooks, which then use it to generate more accurate odds in real time. The faster the data, the faster the betting markets move, and the more opportunities appear for wagers. But technology isn't stopping there. artificial intelligence is now entering the industry. And AI could completely reshape how odds are calculated in the future. Artificial intelligence thrives on large data sets, and sports generate enormous amounts of data every second. Machine learning models can analyze historical games, player performance, weather conditions, tactical patterns, all to generate more accurate probability predictions. Some sportsbooks already rely heavily on algorithmic odds. The goal is simple: reduce uncertainty. Because the more precise the odds become, the more stable the sportsbook's margin becomes. But technology is also opening the door to something else: a new type of betting platform entirely. One that doesn't rely on traditional banks. Cryptocurrency has begun entering the betting world. Some platforms now allow users to wager using digital assets instead of traditional currency. Blockchain technology enables global participation. No banks, no borders, and in some cases, greater anonymity. Supporters argue this makes betting faster and more accessible. Critics warn it could make regulation even harder. Because money can move across jurisdictions instantly, if crypto betting continues to grow, the industry could become even more global than it already is. Which raises a bigger question: how large could this industry actually become? Some analysts believe sports betting could approach $1 trillion in total wagers annually within the next decade. The drivers are already visible: more legalization, more mobile access, more live betting opportunities, more global participation, and more technology shaping the odds. But the biggest factor may simply be human nature. People love uncertainty, competition, and the thrill of risk. Sports betting combines all three, which is why the industry continues expanding year after year. But the most important question isn't how large the market becomes. It's who ultimately profits from it. Sports betting often feels like a contest between bettors. But in reality, the most consistent winner is the system itself. Sportsbooks earn their margin on every wager. Investors profit from growing platforms. Governments collect billions in tax revenue. Meanwhile, the average bettor slowly loses money over time. Not because they are unintelligent, but because the mathematical structure of the system makes long-term profit extremely difficult. And once you understand that structure, the industry begins to look very different. At its core, sports betting is not just a financial system. It's a psychological one. Humans are naturally drawn to uncertainty. The possibility of winning activates reward circuits in the brain, even when the odds are unfavorable. That combination of hope, competition, and unpredictability makes betting incredibly compelling, which is why millions of people participate every day. And that brings us to the final perspective of the industry. What began centuries ago as simple wagers between spectators has evolved into a global financial ecosystem. Technology companies build the platforms, data firms supply the information, investors fund expansion, governments regulate and tax the activity, and millions of fans place bets every day, all connected through a network moving billions of dollars constantly. But behind every wager, there is one statistic that rarely appears in advertisements. Sports betting is often framed as entertainment, and for many people, that is exactly what it is. But at a systemic level, it operates very differently. Small margins, multiplied across enormous volumes of wagers. A model designed to generate consistent profit over time. Which means the real question isn't who wins a bet tonight. It's how much money flows through the system over years. Because hidden behind every betting platform is a statistic most gamblers never see: the average long-term loss per bettor. And once you understand that number, you begin to see the sports betting industry in a completely different light. If this changed how you see money, subscribe.